How much can I make? Professional investors ask a very different question. What could go wrong? That difference alone explains why professionals stay in the game for decades, and why beginners often lose money early and give up. In this video, I'll show you how professional investors think about risk instead of returns, and how you can apply the same mindset even as a complete beginner. Why focusing on returns backfires. Beginners are taught to chase high returns, big winners, the best investment. But here's the problem. Returns are unpredictable. Risk is manageable. You can't control what the market gives you. You can control how much damage you take when things go wrong. Professionals know this, and that's why they survive long enough to win. How beginners define risk. Most beginners think risk means, will I lose money this year? What if the market crashes? What if I pick the wrong stock? Professionals define risk differently. To them, risk isn't short-term losses. Risk is the chance of permanent damage to your capital. Temporary losses are normal. Permanent losses are unacceptable. That mindset changes everything. Temporary loss versus permanent loss. Simple example. Let's say an investment drops 20%. A beginner panics and sells. That loss becomes permanent. A professional asks, is the business still functioning? Is the long-term thesis intact? Do I need this money soon? If the answer is yes, they wait. Professionals expect volatility. They plan for it. Risk isn't the drop. Risk is being forced to act at the worst time. Risk number one, professionals focus on time risk. One of the biggest risks professionals manage is time. They ask, when will I need this money? Can I afford to wait through downturns? Do I have a long enough horizon? Investing money you need soon is risky, even in safe investments. Professionals match investments to time horizon first, not return potential. Beginners often do the opposite. Risk number, concentration risk. Beginners love concentration. One stock. One eye. One sector. Professionals understand. Concentration increases risk faster than it increases reward. They spread exposure across companies, industries, regions, asset types. Diversification isn't about maximizing returns. It's about surviving mistakes. Behavioral risk. Professionals know the most dangerous risk isn't the market. It's your own behavior. Fear causes selling at the bottom. Greed causes buying at the top. Boredom causes overtrading. That's why professionals rely on rules, system, long-term plans, not emotions. If an investment requires constant emotional control, it's probably too risky for you. Risk number 4, ignoring what you don't know. Professionals are comfortable saying, "I don't understand this." Beginners feel pressure to invest anyway. Professionals avoid complexity they can't explain, investments they can't value, strategies they don't fully understand. Unknown risk is often the most dangerous risk. If you can't explain how an investment works in simple terms, you probably shouldn't own it. How beginners can think like professionals. You don't need advanced tools to think like a professional. Just ask better questions. What's the worst-case scenario? Can I survive this going wrong? Do I need this money soon? Am I diversified enough to be wrong? When you manage downside, upside takes care of itself. Professional investors don't win because they predict the future. They win because they control risk, stay invested, and avoid mistakes that knock them out of the game. Focus less on how much you can make. Focus more on how much you can lose and still keep going. That's how real wealth is built. If this helped you think differently about investing, like the video, subscribe for more beginner-friendly investing content, and I'll see you in the next one.